Today, Chris Madrid, Michael Oldham here with you for our Market of the Moment update for the week of August 16th, 2021. How you doing, Chris?
Hey man, all good. Enjoying the monsoon that we're getting in North Texas right now.
Been a little rainy for
A little wet
August.
for a few days. Oh yeah.
Very wet. Looks like maybe a little more coming in. So we're gonna get started today so we don't take a lot of time.
Yeah.
Maybe. So we're going to let Chris get started off with the current mortgage trends. What's the current mortgage rates looking like, Chris?
We're actually down a little bit from where we were a week ago. So that's always, that's always a good thing. I kind of felt we talked about it before that the injection of funds into the infrastructure bill that was rolled out, that would kind of run its course. Now it happened a lot sooner than I thought, but yeah, thankfully, before, I think last week we were high twos, almost like low threes, right? And then we've kind of dropped down a little bit to still high twos, like 2.28, 2.7, 2.8 versus 2.93 where they were last week. So yeah, thankful enough, rates have gotten down a little bit. Man, I foresee over the next handful of months we're just going to be kind of like this, right? I mean, it'll tick up a little bit, just there's a lot of volatility in the market, and of course, anytime there is negative stuff out there from a world economy standpoint, right? So the things going on in Afghanistan right now, not that we obviously encourage those kind of things, but that unfortunately does help rates come down a little bit as well. So I think that's part of it. So right now, this week, rates have been lower than they were last week. So if you didn't like rates last week, you might like them this week.
All right. And then the trends just kind of seem to be following world news, our social economic news here, I guess, with the infrastructure plan, those type of things.
Yeah. It'll be, it'll be interesting, over the next, say, even like 6 to 12 months, to see what happens. Again, I think overall, we're not going to see any type of significant changes, until probably 2023, 24. So I think, over the next couple of years, it'll be just a little bit of, kind of this, just up and down a little bit, up an eighth, up a quarter, down a quarter. Nothing super crazy.
All right. I think he has some updates on Fannie Mae guidelines. So I wanted to let you roll that out and share with everybody.
Yeah, man, absolutely. Yeah. So this last week, actually, Fannie Mae rolled out a couple of updates. And I think it's something that will be not beneficial for everyone, right? But it may, there may be, a handful of people that it'll help. So two big things, two big takeaways. So Fannie Mae is going to now allow lenders to use an actual average credit score on just a conventional product. So for those that don't know, Fannie Mae is kind of the back end investor for conventional financing. So they set the guidelines, or they are one of the entities that sets guidelines for conventional loans only, right? So not FHA, not VA, not USDA, not jumbo, strictly conventional. In North Texas, that's loan amounts 548, 250 or less. Okay. So what they've allowed is, in the event, credit, just specifically credit score related, if you have a customer, right, in the low 600 range, right? So on conventional financing, you can technically go down to a 620 credit score if you have 20% down or more. And then, depending on lender requirements, if you need PMI, so if you're doing less than 20% down, 640 to 660 is where most credit scores have to be. And a lot of the times, there are more when your scores are down in that range, there may be some late payments, things like that. So there's oftentimes there's a risk assessment that's done in the desktop underwriter platform, which is Fannie Mae's automated underwriting system, right? So there's a kind of a risk factor that's assessed, and if you have recent late payments, obviously there's probably more negatives than positives if you're doing less than 20% down, right? So one of the things that they've rolled out is to now allow lenders, allow mortgage companies to include positive rental history, right? So if you have 1 to 5 years of positive rental history, you've never been late, mortgage companies can now include that, and DU, or desktop underwriter, will analyze that in their risk assessment, and it could basically, take you from being approved eligible, which is what we have to have, versus like a refer, from an automated underwriting standpoint, right? So again, it could mean you qualify versus not qualify. So that's now take positive rental history and include that as part of the risk assessment, where before it wasn't required, right? But then it also, like, it didn't help, it didn't hurt, but now we can actually include it to help the overall risk assessment on conventional financing. So that's a big plus. And then the other the other thing that I was talking about, another update from Fannie, is they're now allowing to be able to average credit scores. And again, it may not help as many people as we're thinking, but it still may be an option. Right now, we're seeing a lot of in the competitive market environment that we're in right now, sellers, for whatever reason, like conventional loans versus like an FHA or VA, right? Or they prefer that, right? And you're probably seeing it on your listings, like you're saying, hey, let's look at conventional versus FHA.
Yeah.
So from that perspective, it may help push, push people over the edge, from being able to qualify for conventional over FHA. So we can use an average score of two applicants that are applying together, versus just the lower of the two. So again, it may not help as many as they anticipated or wanted to, but I think it's still a good, we're moving in the right direction from a guideline perspective.
Is there an industry number that they think, like, what percentage of buyers this might affect and help?
No. I'm kind of just thinking back over the last, let's say even over the last, 12 to 18 months, 5%, right, of everyone could probably benefit. It's not very many. But again, if it's, one in 10 that it could help, or, 1 in 20, that's still, again, I think it's just overall we're moving in the right direction.
Yeah, definitely. Let's move on to self-employed borrowers a little bit. I wanted you to talk a little bit about that. I don't know if this is a good segue for that, if this would affect the self-employed borrower at all. But
Yeah.
You talk a little bit about that. There's often self-employed doesn't work exactly
Challenges.
as
Yes.
if you're employed by someone. So I'll let you talk about that for a sec.
Yeah. So there's a couple of instances that we're having challenges with right now. Self-employed being one, and then what we're seeing a lot, and it just may be the kind of the environment that we're in, is something that we have classified as variable income. And that's anytime we have, so your typical W-2, full-time employee, whenever the bank or lender gets their pay stubs, you normally see 40 hours a week at a certain rate of pay, right? What we're seeing now is, 30 hours here, 35 hours here, 42 hours here, 37 hours here, right? So it's never a consistent 40 hours a week. And because of that, that falls into what's called variable income. And instead of being able to just take kind of a year to date and use that amount from a qualification standpoint, most banks and lenders are having to take a 2-year average. And if that 2-year average is more than the year to date, then they're still going off of the lesser of the two. So that's one of the things that we're having to really double check right now on hourly employees, just because there are a lot of variations in hours worked. And then of course that kind of correlates to self-employed, where if you are self-employed and you've been in business for less than 5 years, we have to have 2 years of completed tax returns showing positive income, right? The challenge that I often see is we have customers that just started a business 2 years ago. The first year they had a lot of expenses, right? They had, startup costs and all this stuff. So there's really little to no income that first year. And then the second year, they've done great. They're showing positive income. Well, when we have to go to average those 2 years, it's essentially half. We can only use most likely of what they had earned that go to negative income that they had the first year, right?
Yeah.
So sometimes the challenges that we see if you've for less than 5 years, oftentimes it's just the instability in income.
Okay. All right.
Yeah.
I'm
So
gonna
so
talk.
in a nutshell, we always recommend, hey, if you're in the process, if you think you're going to be buying a house in a couple years, make sure your CPA doesn't get super creative on your taxes, because it could end up messing you up when you're going to buy a house.
Gotcha. We're going to talk a little bit about appraisals during our real estate section here. So we're going to move on to our current real estate trends. Appreciate all those updates. Fannie Mae information, very valuable. So the market for the week of 8/16, not really going to review last week's market because this week's market was so similar. So I'd basically be showing you the same two slides. But in all four counties, things basically remain the same as last week. Still selling in Collin County a little over 5% of lists, still at 5 days on market, and our month supply is still at 1.1. Denton County, we're still at nearly 5% over ask, which was the same as last week. Still 5 days on market average, so moving very quickly, and we're still at a 1.1 month supply there. Dallas County remained the same. You're about 1.2% of lists, which was same as last week. Days on market's the same, about a week, and the month supply was the same. So Grayson County, about the only place things changed a little bit. Pricing stayed the same. Still can get a bargain up there, a little bit under list.
Yeah, 1.4 under list.
Days on market ticked up 1 day versus last week. It was 9 days on market last week, and you got nearly a 2 month supply. So that's very, very much the same. I'd still attribute these numbers to school starting in all these different areas at different times. Some started last week, some's getting started this week. So I still see some people taking that last vacation and things. So I would say that's mainly, where we're at with the market. As far as, I just think it's seasonality. I think it's probably going to open up here 3 weeks or so again. What are your thoughts, Chris, on that?
Yeah, the exact same. I think for the most part, most schools, at least here in kind of the north, North Collin County, North Texas area, have everyone's essentially back in school, right? They've started, or they will be starting, today, tomorrow, right? So as that normalizes, and people can kind of get back to the fact that, hey, we need more space or less space, or we want a pool, or we want this, or we want to move out, we want to move in, whatever it is, right? Those conversations are going to start happening again, and I think we'll be picking back up. What I have seen that's interesting, right, from a market perspective, is even though home sales are going over list, 3 to 4 months ago, we were having conversations about appraisals coming in below what you've offered to pay the seller for a specific home, right? And really, man, over the last 30 days, we're not seeing very, very many low appraisals, not seeing very many low appraisals, if any. And again, I think it's just because the data, right, the information that's out there has finally caught up to the market.
Yeah. We had one come in this week. We were actually, I think, 10% over asking on our offer, and the appraisal even came in over our asking price. So anyway, that's always good for your clients.
Yeah.
We had a full appraisal waiver to pay the difference. So they got a little more money to put down, or a little bit more money to put somewhere else.
Furnish the home, or those are all things that a lot of people aren't thinking about, or not that they're not thinking about, they're just having to make a decision. Either we're going to get this house by offering XYZ amount over, or we're not, right? I mean, that's really what it comes down to.
Yeah. So Amy and I were out at a pool party last week, and the topic of conversation, of course, is I'd love to sell my house, but where am I going to go, and all of those things. So I'm just here to tell you right now, Amy and I can sell your house, but we'll have you in one before we even get that started. So that's what we specialize in. So if that's a fear and you want to get the equity out of your house and get that next one, you can do it. You just have to have a plan. That would probably start with us getting you pre-approved through Chris and through underwriting and ready to go on the next one, get you under contract on that, and then put your home on the market and get it sold in this hot market. So I want to take a little, a second real quick. This is about a 45-second little video, but I don't think we think about, the impact that the economic impact that selling our home actually has on the community, from an financial standpoint, the jobs it creates and those things. So that's what this video deals with. So I don't think many of us think that when we sell our home, we're actually producing jobs, providing income to other families, but that 45,000, nearly 46,000 economic impact you put into the community when you sell your home. And if you buy a new home, that doubles to nearly probably close to $100,000 on the community. Kind of puts a new spin on it.
Oh yeah, for sure.
So as we always say at the end of our little market update, you can get a lot of news out there floating around on Facebook and Twitter and the Gram and on your cable channel. Most of it's not local news. Most of it's not specific to you and where you live. So make sure you reach out to Chris and I. Amy, we always got our thumb on the pulse of what's going on locally. So get in touch with us. We've always got the info. We're trying to do this every week. We've been consistent 3 weeks in a row.
Hey, man,
So,
no doubt.
Next week will be a full month. It'll be a habit before long. So reach out to Amy and I, 469-369-0873. You can get Chris at 214-734-1531. We'll get you taken care of. So anything was close up, Chris?
Oh man, no, it's always great to get this information out there. So
yeah, I think so. So appreciate it. Have a great weekend, and we'll be talking at you soon.
see ya.
All right, man.